Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So we're just traveling back in time, flashback to 2003, to the originator, the OG of velocity banking, which is a dude named Harj Gill from Australia. So in 2003, he published this book, How to Own Your Home Years Sooner Without Making Extra Interest Payments. And so when I first learned velocity banking in 2017, I always heard like, oh, it's from Australia. It's from Australia, right? So this is the dude who originated using your HELOC to pay off your debts quicker, including your mortgage, right? And so one of the things that I've heard from other people who teach velocity banking is to always replace your mortgage with a line of credit, right? You ever hear that on the internet? I've heard that in real life too. And so when I first learned it in Renatus, where I learned it from, the Renatus educational system, which is an online platform, I never heard that, right? Like in the classes themselves, I never heard, oh, you should always replace your loan or your mortgage with the line of credit. So it was never like simplistic thinking, oh, lines of credit always better than loans, loans bad. And so I've seen videos on the internet where the person speaking is like, well, you got a 2.7% mortgage, so, but we got to replace it with a 9% line of credit. And I'm like, are you what? And I've had people actually email me about this, right? And so the reason that I'm talking about this is because um, I'm just going to show you what I know and what other people have known from even from 2003, right? So the originator of the system, again, the OG velocity banking guy is Harj Gill. Now, I personally don't present velocity banking as a system to pay off your mortgage, um, like he does. What I present it as is that it's a tool to increase your cash flow, right, or help you manage your cash flow and debt. That's the way that I present it. But let's go back to his book. So if you want to borrow books at archive.org, you can actually get a copy of it. And then there's like a time limit where you can read it for an hour, and then uh, you can't read it. I guess you check it out the next day. It's kind of weird, like an electronic library. But I have the book open, How to Own Your Own Mortgage, right? And so basically, he says that you have three choices, right? If you're going to pay off your home using a home equity line of credit, and hopefully you can see this, or maybe if I can zoom in, let's just go ahead and zoom in. And he says, after reading chapters, you might think that in order to own your home sooner, you have to change your entire loan to a home equity line of credit and then apply the principle of mortgage elimination I've been talking about. I deliberately structured the book in this way so as not to go into intricacies of the options you can exercise too soon, because I wanted you to focus on getting the workings of the key principle down pat first. Now, I believe you have a good handle on the concept. I can tell you, in fact, you have three options you can apply exercise to apply my mortgage elimination system, all which have their pros and cons. These options are transfer your entire P&I loan to HELOC, which is getting a first lien HELOC and replacing your mortgage. Number two, take out a smaller HELOC as a second mortgage, recommended. And then number three, take out a personal revolving line of credit, which is just a personal line of credit. So let me just kind of go to the next page right here. And number one, convert your entire PNI loan to a HELOC, right? So let me just scroll down here. Um, and it says advantage is easy to manage because you have one account to deal with. Number two, you have access to a larger pool of funds if needed. For example, if you decide to access the equity in your home for large expense items such as upgrading your car renovations, you can withdraw that money without having to refinance. To increase the limit of your HELOC, that is if you have to build up the necessary equity to do this. Disadvantages, you're exposing your entire loan amount to the variable interest rate, right? And this is something that I've talked about before, where if you have a 2% mortgage and you place the entire thing with like a 10% line of credit, you're almost like putting money on the table, and there's no real need to do that. And again, even in 2003, the guy who talked about paying off your home sooner says that this is not his recommended strategy because you're putting your entire loan amount to that high interest rate, right? And then so number two, and so there's other disadvantages too, but that's like the main one. Take out a smaller HELOC as a second mortgage. I would recommend that you give this option serious consideration because it has major advantages, right? Some major advantages over option one. Does rather than taking out a HELOC for the entire loan amount of your mortgage, you would take out a smaller HELOC as a second mortgage and then apply the mortgage elimination system to reduce it quicker, right? And then so he basically has a case study, and we kind of have gone over this in many, many videos, right? I'm not going to read the whole thing, but my point is, listen, even in 2003, they knew, he knew that you don't need to replace your entire mortgage or line of credit. And again, like I said before, the reason I talk about this is because I get random emails about, hey, I'm thinking about doing this, and they got like a 2 point something percent interest rate. I'm like, what? And we go over this in our velocity banking videos as well. And in fact, why don't we just do it again, right? So we'll go ahead and fill out that sweet, sweet YouTube runtime. But I know you're also addicted to this content as well. So here I have another sample velocity banking spreadsheet, right? We've kind of done it with a little bit lower income than what we traditionally do. Most people complain like, hey, most people don't have $5,000 of income. Well, guess what? Most people don't have mortgages either, right? So, and why don't most people have mortgages? Because banks don't lend money to people who need it, and because most people need money, they're never going to get that much debt. All right, so now let's go ahead and review velocity banking. What is velocity banking? All it is a debt payoff strategy using your line of credit as your main operating account. And there's only two things you need for it. Number one is a budget. Number two is a line of credit as your main operating account. So as you can see, I have a budget here, $4,000 income, $3,400 expenses, $500 of savings every month. And the whole point of this is to eliminate debt. So when we do our budget and do our expense breakdown, we have to list every single debt that we have, right? So we have 2 credit cards, 2 student loans, an auto loan, and a mortgage. And so if we scroll down here, so we see that the goal is to pay out $213,000 of debt, right? And we're also going to assume that our income stays the same. So when we do velocity banking, the income is zero, but the savings, there is no savings. But we're going to have something called cash flow, which looks like savings in the very beginning, right? Which looks like savings in the very beginning. Okay, so now let's go ahead and do this. And so we have this thing called cash flow. Now, how can our savings be zero yet our cash flow be 527? That's because the velocity banking strategy, when we make our line of credit as our main operating account, um, it's always going to be zero. We're not going to have any money in our savings account. Yet our balance is going to go down by our cash flow plus the interest on the line of credit when we use to consolidate um, our debts and cash flow. All right, so what is the actual velocity banking strategy? It is income into line of credit and then expenses, and I got to change this symbol, out of the line of credit, right? So expenses out of line of credit. And so now let's go ahead and make our line of credit as our main operating account. So you might be, what is a line of credit? In fact, one of my friends asked me that. He has real estate in Los Angeles, had no idea what a line of credit was. And all it is a financial tool where you could borrow money, pay back, and use it over and over again. That's the line of credit. It's easy, right? If you have a credit card, that's the line of credit, but it's not, you don't have the complete freedom to use it however you wish, unlike a personal or a home equity or a business line of credit. Now, there are some restrictions, contractual restrictions, like, for example, a lot of home equity lines of credit, they kind of say in their contract, don't use it for like business purposes or, buying stocks or crypto or something like that. So always check your terms and conditions. But in general, with the HELOC, home equity line of credit, or a personal line of credit, you can use it to pay anything, right? Credit cards you can't, but still type of line of credit because credit cards have the two-way revolving principle that loans do not, right? Okay, so now let's go ahead and move some of this debt. So we have 11,000 right here. So 11,000, that's the balance of the loan. And guess what happens when we just move these 2 credit cards into that line of credit? We'll say it's a home equity at 10%. All home equity line of credit means is that you're putting giving collateral to the bank to give you higher limits and lower interest rates, right? But whether it's a personal or home equity line of credit, it basically functions the same, but you get better terms and rates if you do provide collateral. And home equity is our collateral for this case. Okay, so now that we've transferred the debt, guess what? Now our cash flow moved from 527 to 897 in one swoop, right? And so now let's go ahead and do this. So we're going to take the previous month and add 1, and then we're going to take the previous month's balance plus the previous month's interest minus this cash flow number, so 897.94. And then we need to calculate the interest, which is going to be based on this thing called the average daily balance, right? So we estimate it here, multiply it by 0.1, which is the interest rate, divided by 12, right? And so now I'm going to go ahead and copy and paste this. And let's see, it takes about 13 months to pay it off. Beautiful, 13 months. And let's also record this as a milestone. So 13 months to pay off 11K. Whoo-wee, that's pretty sweet, right? And so now we got to figure out, all right, student loan, auto loan, mortgage, which one do we pay off? And what we have is this loan calculation sheet. So we just give it what the current month is. So it's 13, right, for all of them. We paid it off in about 13 months. Is that right? Let me just quickly check. Yeah, 13 months. And so now what we do is we get to see the latest balances, and we also want to see the cash flow indexes. So if you don't know what cash flow index is, all it is a simple formula that's kind of like a ranking system that tells you which debts to pay off. So for example, a low number is the one you usually want to attack first. So if I have to pay 14 grand, so let me do a quick comparison. Would I rather pay 14 grand to get $352 back, or about 13 grand to get 155? I would definitely pay this 14 grand first because I get more bang for my buck in terms of the cash flow that I recover. And remember, for amortized loans, the payment is the same most of the time, unless it's like one of those ARM loans or variable interest rate loans. I think I've never dealt with the variable interest rate loan or ARM loan, but for the most part, if you have an amortized fixed rate loan, the payment stays the same. So when we pay off the loan, we recover this in our payment. And so I'm going to focus on this lowest cash flow index number, right? And with the balance, now we can just copy. So 14579.25. So let's go ahead and copy this. All right, so let's go ahead and copy this. And then let's go ahead and paste it as well. So let me put this right here. So 14579.25, right? So now we've added that here, but when we move that loan, right, guess what happens to our cash flow? Well, it's going to increase by $352.19, right? So let's go ahead and put this to 0. And now what's our cash flow? Oh my goodness, it's over. We went from $500 to $1,200 in about 13 months, right? So 1250.13, okay, minus 1250.13. And then now, whoopsie, no, that's wrong. This is where 1250.13 comes in. 1250.13. All right. So now let's go ahead and copy and paste this. And when we see in month 26, it's gone. All right. So month 26, that auto loan is gone, right? Did I do it right? Hopefully I did it right. Did I screw up? No, I got it. 18,000. Okay. So 26 months, so another 13 months. So that's 11K plus 19K, so that's 29K. It's all gone, right? And now what we got to do is look back. So let's just put in. So this is completely gone. And I probably need to do this a little bit better, so I could just put an X to say it's completely paid off. But the way that you can make it go to 0 is just 5 times 12, right? So it's D4 times 12, and then that'll be 60 months, and then 60 months is when the balance is 0. Okay, so now let's go ahead and do this. So we have 26, my bad, 26, 26, 26. And so we have 2 cash flow indexes that are very similar here. Very similar. And for paying these two loans off, we get about 200, 300, about $350 back. It probably might be better just to pay these loans off one at a time. So I might go for this one because it has a lower balance and the cash flow index of these are nearly the same. So let's go ahead and move these or move this one. So let's go ahead and do that. And then right here, ba 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 ba. All right. So now let's move this loan. So 12295.99, right? And now what's our new cash flow, right? So I think this was student loan one, right? So student loan one, okay, so this goes to zero. And now our cash flow is 1405.59. So let's go back here. Minus 1405.59. Hey, every little dollar counts, right? So let's go ahead and do that. All right. So now month 35, that's all paid off. And then let's just go back right here. So 35 months. And then now it's 29 plus 15. So it's 44K, right? So 44K. And then now let's go ahead at 35 months. So this is paid off. So at 35 months, what is the current balance of everything? So for about 14 grand again. So let's go ahead and move that. Bam. Whoopsie. Let me go back and forth. All right. 14273.113. All right. So now, okay, we moved it here. How much cash flow did we recover? An extra 200 bucks. Bam. And what's our current cash flow? 1600.67, right? 1600.67. So let's go ahead and do that right here. So 1600.67. And then, all right, so let's copy and paste. And then we see in 44 months, this is paid off, right? So 44 months. See how easy that was? 44 months, and then it's 44 plus 19. That's 63K. And now we're at the finale, which is the mortgage, right? So so let's go here, and now this is paid off. And then if we go back here, it's 44 months. So this is the current balance of that loan, 142. Now, when we have a loan like a mortgage, we again, this goes back to Harj Gill's statement about you don't want to replace your entire mortgage with the line of credit, right? Or it's not recommended. So we have two options here. We can replace our entire mortgage with the line of credit, and I have actually a velocity banking calculator show you what happens when we do that. We can dump our entire $1,600 into the mortgage, or we can use a line of credit to help pay it off and still manage our cash flow and have it in one place so we prevent something called a segregation of income effect, right? Now, I know, and I think you know from most people's experiences, that most people tend not to overpay loans. And why is that? It's because a loan is a one-way street. When you overpay it, you never get that money back unlike a line of credit, right? And so what we're trying to do is just get the best of both worlds where we could pay it off early and have access to our cash and make it easy for us to do. I think people discount very easy to do, right? Like UPS, right? They're not stupid. They know that making a left turn is actually more efficient than constantly having to make rights. But why do they ban left turns? Because left turns are dangerous and very inconvenient. So it's actually faster for them to always take the safer route of making a right than to make a left turn, right? It's the same thing with the loan. Like you can overpay your loan, but if you ever needed that money back, they will never ever give it back to you, which is why loans have lower interest rates because they have less features, right? Same thing with any software package. Less features equals less money. A loan is a debt where you don't have two-way access to your money, unlike a line of credit. Now, let me pull out this velocity banking calculator to show you how it would work. So let's give me one moment. So let me just open it up. Where'd it go? Do I even have it open? No, probably not. All right, so let me go ahead and open it up. All right, so now let's move that window. Wait a minute, one second. There we go. So all we got to do is now fill in the numbers, right? And that should be it. So let's just go ahead, 30 years with 6% interest rate. And I'm just going to take a look at my other screen quickly. So it's a $150,000 mortgage, 150000, and the current balance is 142 142,671.27. Okay. So now, again, so let's go ahead and fill in our income. Our income is not this, definitely. It is $4,000. So let's take a look at this. So it's $4,000. Okay. Let me just move this to 5,000. And then what is our expenses? Our expenses is 1,500. So let me type in 1,500 here. Okay. So now let's focus on this, right? So let's say we decide that we're going to put the entire thing into into the line of credit, right? The entire thing into the line of credit. Well, if I put in this number 142,671.27, right, because it's the current balance, take a look at this. You might be impressed and say, ooh, that takes 6.5 years to pay off, right? And you save $88,000 of interest. Okay, so it is true, it does get paid off faster. Um, but let's just go ahead and do, little chunks, which is the option number 2 that Harsh talked about. So 5000, and then, this is 52 grand and 6.5 years. Look at that. This kind of halved, right? This kind of halved. Okay? So 6.5 to 5.7, right? And now we only pay $26,000 of interest. Okay? So as you can see here, there was no need for us to replace our entire mortgage and line of credit. And we could see that with this calculator. We see it from Harge's, the OG Velocity Bankers book in 2003. And yeah, so basically that'd be it. And you could see here in 5.7 years, we pay it off. So let's go ahead and look at the other Velocity Banking spreadsheet right there. Oh, okay. So right there, 5.7 years. So now what we do is just write this 44 divided by 12 plus 5.7. So in 9.3 years, we are debt free. Woohoo. 213,000 debt free. And you might say, why does it take so fast? Again, it's based on our cash flow. And if you're, and sometimes you might have little cash flow, but you might have a ton of income, and that's actually a better proposition than not as much income. And even you could have even more cash flow than someone who has more income, but the more income always wins, right? You guys seen those videos where like someone had 1 penny in savings, but they had like 9,000 or 10,000 income? That person pays off debt faster than someone who does not have income, right? So, all right, so 9.3 years debt free. And is there anything else I want to mention? So let's go back to that Velocity Banking spreadsheet right there. Again, you might be wondering, what is all this from? Where did I get it from? I got it from Renatus, where I originally learned it from in 2017. And so, full disclosure, I sell these educational packages as an independent contracted marketer. I get commission off of them. And so, if you're interested in not only learning about velocity banking, but also real estate investing, financial literacy, look it up. Renatus um, real estate education or your Renatus Velocity Banking Google, and then you can see they have a course catalog of all of these things that you can learn, and Velocity Banking is one of them, right? So 5.7 years, woohoo! I mean, so I'll just use a second lien HELOC until my debt is paid off, then I'll get a first lien HELOC, right? So something that you can do. All right, well, that's it for today. This is Korean Atlanta Mentorship, just a flashback to 2003. No need to replace your mortgage to line of credit. You can just use a second lien HELOC and you'll be perfectly fine. All right, have a great day, everybody, and we will speak next time.